It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by firsthourtrading.com.
Welcome to this edition of the TradingTips.com video newsletter. In this episode, we'll be looking at a stock market breadth indicator, percent above moving average. This indicator measures the percentage of stocks trading above their moving averages, and it can be useful in spotting broad market trends. Without further ado, let's begin. First, let's take a quick review of moving averages in general. A moving average gets the average share price of a stock over a specified amount of time. For example, let's say 10 days. A stock's 10-day moving average can be found very simply. You add up the last 10 closing prices and then divide by 10. On the 11th day, the oldest day's data is dropped from the total, and it's replaced by the new day's data, and that's why this is a moving average. The average changes because the numbers it's looking at changes over time. It moves. Moving averages can be simple or exponential. So far, we've been talking about them in simple terms, where you just take the sum and divide by the total number. An exponential moving average is different in that it has more complex math and gives greater emphasis and weight to the more recent prices. We'll stick with simple moving averages for this episode. And finally, moving averages can be for any span of time, but popular ones are for 10, 50, and 200 days. 100 and 150 days are also somewhat common. Okay, now that we've taken a look at moving averages and we've gotten all that pretty well defined, let's look at percent above moving average, which is the technical indicator we're looking at in this episode. We first have to determine what stocks we're looking at and then which moving average we're considering. Percentage of what stocks above which moving average. That's what we're looking at after all. For the first question, let's use the S&P 500. That's simple. For the second, we'll use the 50-day moving average. A 50-day moving average will be more volatile and create more whipsaws, but longer moving averages just aren't well suited for shorter-term traders, which many of us are. Here we have a 6-month chart of the S&P 500. The solid line that switches from red to black, that's the percentage of S&P 500 stocks trading above their 50-day moving averages. The solid blue line is the 50% mark. When the solid red or black line is above that blue line, this means that there are more than 250 of the S&P 500 stocks that are trading above their 50-day moving averages. And when that solid red/black line is below the blue line, this means that fewer than 250 of the S&P 500 stocks are above their 50-day moving averages. Take a look at this chart and take a moment with it. What does the percentage above moving average indicator tell us? Can you tell from the chart? Focus on point A. Here we have one of the whipsaws that we warned about. The number of stocks trading above their 50-day moving average briefly dipped into sub 50% territory and then bounced right back. If you sold on the bearish crossover, meaning when the solid red-black line dipped below the blue line, then you acted rashly. You should have waited for confirmation, which would be another day or two, continuing to trade below that 50% mark. So why use a 50-day moving average if it's more volatile? Because they work better for short-term trading. Just be sure to wait for signals to be confirmed. Just be sure to wait for crossovers to be confirmed. Now, you'll notice here, right after the bearish crossover at point A, there was a bullish crossover, and this one confirmed. The S&P 500 surged from 1555 on April 19 to as high as 1674 on May 28, a gain of 7.6% in just over a month. These gains could have been predicted using percent above moving average and by being disciplined. At point B, we have a definitive bearish crossover, which was followed up by massive losses for the stock market. At point C, there was a bullish crossover, followed by gains of almost 4% over the next 3 weeks. But after a recent whipsaw at point D, the S&P 500 has had another bearish crossover with a number of confirmation days, and the number of stocks trading above their 50-day moving averages has dropped well below 50%. What does this mean? Here we have the same S&P 500 chart we've been looking at, but this time we've shaded in the areas where percent above moving average was greater than 70 or less than 30. When greater than 70, stocks look overbought. When less than 30, stocks look oversold. The recent sell-off has put stocks near oversold territory, which would be bullish. This is as of September 2, 2013. A good strategy for buying stocks using percent above moving average might look like this. First, buy stocks on the second day following a bullish crossover. That is, the second day after more than 50% of the S&P 500 stocks are trading above their 50-day moving average lines. Then, sell for a profit when percent above moving average gets into overbought territory. That is, when it's 70% or higher for 2 straight days. Sell for a loss should the percent above moving average fall below 50% for 2 straight days. Or, as an alternative, you could short stocks when the S&P 500 experienced a bearish percent above moving average crossover, and then take profits once the percent above moving average reached oversold levels. In conclusion, percent above moving average is a great breadth indicator. It's easier to pick stocks in a rally of greater breadth, and that can sometimes be obfuscated by a few standout stocks taking the averages higher. Checking percent above moving average is a good idea before entering any position. From there, you can use it to guide you when to buy, sell for a profit, or even take losses if you have to. Percent above moving average can also be used to identify good short sale candidates, and for that matter, it can be useful for identifying calls and puts. When used in conjunction with other technical tools, percent above moving average is definitely a good one to have in your arsenal. We hope you've enjoyed this TradingTips.com video newsletter. Thanks for watching and good trading.
This Trading Tips video newsletter has been brought to you by Manny Bacchus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system. The First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. View more Trading Tips videos. Visit tradingtips.com. Sign up for our free video newsletters and become a successful trader today.